Hello, everyone. It's a real pleasure to be speaking with Otavio Costa, or Tavi, as people in the industry know, and he likes to be called. He's been at Crescat Capital since 2013. Now, if you're in this space, you know Tavi very well. He is a prolific writer. His research has been shared and shown on lots of publications, including Bloomberg, the Wall Street Journal, Reuters, Yahoo Finance, Real Vision, and many, many others. Now, I really enjoy seeing his presentations, which I've been lucky to see in Las Vegas, in Vancouver, in Toronto. This is a wonderful macroeconomic perspective, and its thematic approach. It's really diving into the data and into the real numbers. And this is a really refreshing approach to look at some of the news that's out there from a different angle. Now, Crescat Capital, as you may or may not know, has 3 hedge funds and 2 separately managed account strategies, and their goal is to deliver significant alpha relative to the benchmarks. Let's jump in and speak to Tavi. I've been looking forward to having this conversation for some time. So good morning, Tavi. It's great to have you. I want to jump in right now because it's something I've been paying attention to for quite some time, but BRICS, and I know you like to talk about it, but especially in regards to, I guess, kind of gold and US Treasuries and what we're seeing in a political, but also the markets, what seems to be happening. There's a divide occurring, and it's not getting as much love or attention, I would say, in the mainstream, as I think it is a very serious topic that one has to consider.
Yeah, look, the BRICS, we can put them as a block and also separate them in different ways. As a block, we're seeing a big selling of treasuries or declining of their holdings of US Treasuries in the recent years, which is an interesting phenomenon that we haven't seen in a while. They were the biggest buyers of treasuries over at least since the global financial crisis, and now we're seeing a transfer out of that trend and seeing them actually buying gold. While China has been one of the main ones, we also saw other economies like India and Brazil and even Russia, which is undisclosed how much they've really been purchasing, that have substantially increased their holdings. Now, from a global perspective, the BRICS is where I tend to have a different view than most people in the world regarding this block of countries, is that they're anything but a block, in my opinion, because when you look into it, China, for instance, very challenging demographics, and you have a net importer of commodities and all sorts of issues when it comes to the political leadership. And then you have Russia, also have all sorts of issues as a geopolitical player, but now an exporter of commodities, and completely different than China when it comes to the exposure to natural resources in the future. Then you have India, a completely different animal as well, which has better demographics, probably one of the best in the world, but now also a commodity importer. And then you finally have Brazil, not talk about South Africa and so forth, but those are the most important countries. And you have Brazil, which to me is the most opportunistic, given the exposure that it has to natural resources, less of an authoritarian political regime, although we have a political leader that is authoritarian. The constitution, the Brazilian constitution, and the way things work are slightly better than China, slightly better than Russia, more similar to India. And so you can kind of see where, from a comparative analysis, is slightly better than the others as well, even from a valuation perspective. So that's sort of how I see the gold trade, but also the resource trade and opportunity across the BRICS overall.
I know when I first started looking like 6-7 years ago, you could see that there was net inflows from a lot of the BRICS countries buying gold, even at like 940, 950. It's small amounts, but they were, and that had caught my interest back then. But certainly now, when you see the lack of attention and desire by China for any of the treasury, they're just not interested. It's tough because, like you said, this is a strange group. I mean, certainly China and India don't get along. I mean, they have constant conflict on their borders. That, yes, they might be banding together for some possible economic reason, but these are tentative friends, to say the least. Like, the bond isn't there, as you'd say, a bond between some Western countries where it's a long-term issue. There's been a lot of tradition in it. Some of these bonds might be more opportunistic, but at the same time, without blowing it off, you think, Yeah, but this is happening. Like they are these countries, whether by themselves, they seem to be acknowledging that the U.S. dollar is in trouble and that we need to find something secure. And what's got 6,000 years worth of data, but gold.
Yeah, look, I've had a very bearish view regarding China for a long time. We've been one of the big writers about the Chinese economy for a long, long time. And recently we've had stopped, I would say over the last 2 years, because we have basically taken away all of our positions in China. And I'll explain a little bit why. Back in the days, we used to talk about the risk. I think there was sort of a disconnect in the media and also in market participants in terms of views about China. There was a very large community that believed China was going to take over the world, become the largest economy in the world, and also the most prosperous, and sort of the next leader in terms of economic growth in this global economy environment. Now, the second part of it, which was usually a minority view, was certainly of the view that China was going to implode, have a debt crisis, potentially a monetary crisis, and all sorts of issues, and many of their real estate companies and other banks would actually go bankrupt. That ended up proving to be right in the near term. And we had shorts on Sunak, Evergrande, and all sorts of companies. And in fact, it was a very challenging environment to actually put those trades on. We actually had to create vehicles with some of our brokers in order to have exposure to those equity names, because they used to suspend trading, and it was very difficult for short sellers to have a position in those things. Now, we have seen a very strong cleaning out process in China, meaning some of the companies, or most of the companies, have gone bankrupt that I just discussed. Others have basically have gone from a very frothy multiples to basically near zero. And so it has changed completely the environment and the asymmetry to put a trade on. Now, if I think about China and put my hat on in terms of what I think will likely happen here in the following 2 to 3 decades, I think China's in a similar position that Japan was, where things got very frothy back in the late 80s and early 90s. We had a bubble that burst, and then we've had a 20 to 30 years of stagnation that just now, after being basically a value trap for 20 to 30 years, we started seeing the Japanese market come back and actually, start seeing some reflation that we haven't seen in many decades. And so I think China is going to go through something similar. And I think the risk of that is exactly the risk that we saw with the Japanese yen. Japanese yen actually entering a collapse of value. I think it's highly likely. Now, the time to be bearish on China and short most of the Chinese names, I don't think it's now. It was 5 years ago. And so I'm flat on that position. And but I think it's important to have a view in China if you want to have a view about the global economy.
And while we're talking about this view, so people, if they want to engage with Crescat, I mean, you've got 3 hedge funds and 2 other strategies. So you've got a global macro, a long short, and a precious metals fund. Maybe tell us a little bit about those 3, and as well as the 2 other strategies.
Well, the global macro is the one that encompasses all of our ideas in any asset class and any themes that we end up playing, which I'm happy to share more about those themes. The long short, which is a second fund, and it's the longest running fund we have, goes back to the early 2000s, was actually it's just the equity version of our global macro today. So basically, think about equity only, long and short version of how do we express all of our views. And then we have a precious metals fund because we were so bullish about metals overall that we end up thinking about, why don't we take the sleeve of our metals theme in the global macro and long short fund and create a whole fund that is dedicated towards that? Because a lot of people don't believe in our other themes, but believe in the metals industry and the opportunity there quite a lot. So we thought about maybe we can create more of an activist approach, and this is sort of developing views through a lot of research. First, yes, let's buy the miners. We think gold is undervalued. How do we position this? And then we start learning more and more about the industry and realize that there is a lack of geologists in the space, and that creates inefficiencies in different parts of the mining industry, especially the ones that require more geology knowledge. Those are usually explorers. The more early stage the story, more you require geology knowledge. we said, okay, well, let's partner with one of the best geologists in the world when it comes to exploration. That's Quinton Henney. And let's maybe buy a bunch of companies that we think have a lot of potential to become major discoveries, in which, as they improve the intrinsic value and the potential for finding those major discoveries, the price of those assets are not actually reflecting those improvements of probabilities. And so we started to basically accumulate a bunch of them. And we've had major discoveries in our portfolio that actually end up being the only fund that I know of that, since the gold market, then since we started actually in August 2020, really been up since that time. And just now gold started moving, but if you look at the miners, it's been a very difficult place to be invested in the space. And so, but that's really on the back of finding major discoveries. Now, I think that the opportunity here is not only in this inefficiency of the mining industry coming from the exploration side of it, but now as gold prices begin to rise and we see the economics of most of those projects improving, I think that's going to be a secular movement towards this entire industry. And so I don't want to be the guy that is buying everything after a breakout. I want to accumulate assets and become, a very niche investor that understands this industry as well as it can possibly be understood, and hopefully be that manager that can take advantage of what I think is going to be one of the best opportunities of at least my career.
And you guys certainly have grabbed that in the last 3-4 years, especially, that I can think of, really charged forward, grasping this sector. Every Friday you have your talks with Quinton Henning as well. You talk about the projects. That's open to anyone to go watch and listen to. You can see the process that you guys go through. That alone, although for someone new might think, oh, it's very long, but you can pick the different pieces you want to watch, and to give that insight out there to anyone that this is where we're thinking, these are the companies, this is how it's going. That's a big move that a lot of funds don't do. They don't have that kind of openness to explain how they're thinking, where they're going. And I think that has not only brought the visibility to Crescat, but has certainly helped educate people into the space.
Yeah, and I think the way we think about this is the following. Look, anytime you make an investment in a mining industry, at least for us, it's usually with the idea, it doesn't mean it will be, that we think this is a scalable major discovery that majors are going to be willing to either purchase to improve the quality of their own reserves, or also for it to be developed because it's large enough that it attracts capital to be developed at some point. So that's the first thing that we think about. And when we do these videos, basically it's, well, to tell the story, to kind of explain a little bit, but it is us using our activist role. Our activist role is usually, rather than just passively own some of those assets, and passive investment is just so popular today. The active investment has just completely been thrown out of the window, and it's just such a contrarian way to invest nowadays. But it's so important in an industry that is so distressed, because basically the idea is, yes, we see the probability. We understand that there is a probability of something to be there, but we don't know if it is or not. But rather than just buying that probability, which looks attractive on its own merits, it's even better if you can add an expert and adding an activist role, in which increases now the chances of you being right. And I don't know of any industry that is capable of doing that today. And I'm sure there are some, especially in the natural resource space, that you're able to acquire a position that way and use expertise to then improve your odds of either a major discovery or a success in your investment. And so that's essentially the way we try to play this. And a lot of people have avoided to invest in this part of the industry, given the liquidity and other issues. And the main thing we hear from institutions, because we talk to a lot of them, is that, look, I love what you guys are doing, but there's not enough liquidity yet. I want to be the one that buys all this prior to the liquidity. I want to be the one actually that brings the liquidity. And so I think that there is a potential for us entering a speculative environment that we've seen in prior years during gold cycles. I can go on and on why I think the macro tailwind looks so attractive for the next 5, 10, even 15 years. And then I look at the duration of the mining industry, which is so different than other commodities like agricultural. You can fix the supply side. What do I mean about duration? You can fix the supply side of agriculture very quickly, supposedly. 2 to 3 years can change the dynamic quite a lot. So if prices go up a lot, producers can actually do something about most agricultural commodities and shift the supply curve in a large way. Now, in the metals and mining industry, given the need for approvals and the complexity, not only to raise money, but to understand a deposit, to find a deposit, and so forth, it may take even 10 to 15 years for you to get something into production if you're lucky. And so as we know this as a fact from at least from prior decades, we understand that that's what causes these cycles of metals to be so long. And so this is why if you're trying to establish a fund that is going to take that approach that is a little less liquid, but also offers supposedly more upside given the risk as well, and then adding this activist role into it, I can't think of a better thing to do than this. And, we can discuss maybe oil is also another one that you can do that. But we understand there's also a political movement against oil. And I love oil. I'm long oil. I think oil is going higher. I think nat gas is going higher. I've had different very similar views in that front. But when I think about the metals and mining industry and how depressed they are relative to history and all this macro developments happening today across reshoring, green revolution, it's hard to believe we're going to see all that happening, revamping of manufacturing without making the metals and mining industry at least more relevant than what it is currently, which is basically a margin error. So, to me, that's really the case of why we're doing what we're doing.
I always try to liken this to like your first day in an economics class, and someone talks about like an unloved market, and they say, well, we don't make buggy whips anymore. You say, well, okay, that's fine. But most people don't realize, they're only starting to somewhat realize that you can't have any of these solutions that they want unless there's mining. And you go, and like you said, it's so unloved, unthought of, underinvested in, that sooner or later, and I would argue that that's starting to happen with more. CNBC is recognizing this. World Bank is coming out saying things. You name it, they're saying the need for critical metals is at a huge point. And also, that ties into, it's a small market. Like people are so used to talking about AI in the trillions. If you attempted to put the money that's required into the R&D or the exploration and to some of these actual producers, that's very, well, I hate to use the word inflationary, but it's certainly very positive.
Yeah, I completely agree. There is I think it's easier said than done when we talk about buying low and selling high. Investors, and the reason for that is because investors will come up with all sorts of reasons why you should not be buying low. And when things start really moving, then they want to buy, but that's not buying low. It's buying at a certain price that has gone up drastically from the levels that you're supposed to be entering. And this is just, it's almost like you have to have a level of conviction. I always say this, you can borrow someone's thesis, but you can never borrow their conviction. And conviction is such an important aspect of being an investor because you will be tested. I don't care what thesis it is yours. You will be tested at some point in the market. And if you don't have the conviction, you don't add at those lows. And that's really where the capital is really generated in terms of returns, is being able to acquire assets when they're cheap. And it's such an important aspect. I go to a lot of conferences like yourself as well too in the mining industry, and I notice the changes we're seeing in this industry in terms of copper being getting a bigger name. You're seeing lithium companies, in which we didn't see that many lithium companies 5 years, 7 years ago, and now we have a big change in this industry. And I was speaking with this guy, having lunch with this guy, which, by the way, calls himself a contrarian investor, and I do think he is. I don't know many guys that made money buying Venezuelan bonds recently, so props to this guy. But I was sitting down at a table with him, and I consider this guy definitely a contrarian investor. And I asked him, what brings you to a mining industry, a mining conference? Why you're here? And he was fascinated by lithium. And I said, well, look, I understand, but you can't say that lithium is supposedly a contrarian a contrarian take in this whole industry. I mean, can you find anything more contrarian than gold junior mining? I can't. I mean, even the coal industry looks more attractive in terms of sentiment than the actual gold, because at least the coal industry actually made money recently, so investors feel good about themselves. The cannabis industry, I can find all sorts of people. Maybe the sentiment has gone down drastically from where it was 5 years ago, but certainly is not at the lows like it is the gold junior mining industry. I mean, the gold junior mining industry is just so hated. And to me, it's one of the best places to be looking at. And so I think that this is, to me, a very interesting and attractive opportunity. I look at valuations quite a lot. I try to understand the historical perspective of things. My read is that we haven't seen this level of sentiment and distress since the 1970s. I think the early 2000s was a very different environment relative to today in terms of that. And I think that turned out to be an incredible time to be allocating capital in this industry. So to me, this is the time to be really diving in and understanding so you can navigate the space as well as possible.
I mean, I love looking at your posts on LinkedIn. You put things out all the time. And this comes back to that conviction, because often in a fund, or even if I'm talking to someone, they'll forget, oh, wait, why did I buy this? And they're not in the field like we are every day, seeing this and going, this is happening. Like we're looking at this all day long. You need to have that activist approach to remind them, this is why you're in this, because they've got jobs, they're focused on other things. So it's so beneficial to have this thesis, and then have the activist approach to remind people, like, listen, we might have to do a bit of hand holding here, but we're going to remind you of the conviction of this trade, or what the position is, and having that macro, like, historical look that you often take to show people that they can forget that very quickly. But having that activist approach really brings them back into thinking, yes, I'm looking for deep value. And if I'm looking for deep value, and in mining, there may not be exciting news every week, every month, every quarter. It's a longer process. And that takes a level of patience on top of conviction that we're not seeing as much out there anymore.
And a lot of times you're the one that have to generate the positive news. You're the one who needs to work hard to make that be the case. And that's when an activist investor, that's what it takes. And regardless if it is, finding, major companies to make a strategic investment in your business, or if it is, designing a drill season that is different than what the market is expecting. What if it's just a capital allocation aspect and trying to drive the right people to the story? There's all sorts of things you can be involved doing. And unfortunately, people don't see this as a venture capital kind of approach, where not all of your investments are going to work out, but only if a few of them work, that's where the return really is. And when we looked at our portfolio, and just as you know very well, a simple way that we like to look at is basically measuring if we've had over 3 discovery holes. Discovery holes are usually measured in a gold equivalent basis. If you look at meters versus grams per tons, it's usually, if you got holes over 100 in that metric or that measurement, usually you have a discovery hole. If you have 3 of those in different parts of the system, then you have what it's called a discovery hole. And when we think about our portfolio, at least 60% of it is already in sort of that realm. And that doesn't mean the other 40% is not onto discoveries. A lot of those are pre-drilling stories. But what it means is that there is a very high probability that there is some mineral deposit of some shape or kind of in the ground. And so, for us, it's trying to, obviously maximize that those are going to be scalable types of discoveries. And as we figure out more and more about those, then you should see a reflection in the price at some point. And only the real successful stories have actually been reflected in markets like Snowline. We've had the story with Newfound Gold, which we bought at pre-IPO. And we had some others as well, like Hercules Silver and so forth. And now we are having success with San Cristobal, though it's a private company in Bolivia. And so, all sorts of things, they usually happen And I mean, this market, the way it is, it really doesn't matter if it's a bear market, a bull market. If it is a discovery and it's a high quality one, it will be repriced and will be probably be beneficial for investors. And so focusing on those is the most important thing. And ultimately, the tailwind from the macro side, as we see capital flowing into the industry from the gold movement to the then silver movement and other metals, and then into the majors, and then into the developers, and finally into the explorers. We all know that the tailwind, when that comes in, it tends to be quite explosive, and that's where the real opportunity is as well. It's matching both. Is the micro opportunity, but also the macro, and that's when I think it's going to be quite attractive for our own clients and our own capital that has been deployed in the space.
Well, let me see if I can put you on the spot a little bit, because I can hear all the voices screaming at me asking, well, Tavi, when's this going to happen? We see gold here. Is it hitting the producers yet? And then how long does it take? How many weeks to, I mean, I know you can't answer that by how many days, weeks, or months, but do we have a sense of when we see a gold movement like this, we know that give or take X amount of time, it hits the producers, then it starts trickling down. Can you say that there is a time frame, or is it every time it's slightly different?
And by the way, we often hear this, and I just said that, but technically throughout history, not every time has played out that way. We've seen actually in prior history, or I should say prior analogs, where silver actually started leading the way, or the miners are starting leading the way.
Okay.
It really kind of depends. In this situation, given the cost structure of the mining industry, we have not seen the money flow into the space because the economics, obviously, I mean, the most obvious take about the miners is that they don't make any money. I mean, I am so tired of hearing that. I've heard this so many times. And it is true. It is true from a perspective of the last 2 to 3 decades or so. It's been very difficult, even in the gold industry, or the gold cycle of the early 2000s. If you look at the gold miners to gold ratio, that ratio did not rise substantially. So, but still, it was a very good market. People made a lot of money. Some people actually became billionaires on the back of that cycle, Eric Sprott being one of them. And so there are people that actually made a ton of money, despite the fact it wasn't a perfect, sort of gold miners to gold ratio environment, which we saw back in the 70s. And so I try to not get too hung up into, those technicalities of, well, I'm seeing silver starting to move, but platinum is not moving. So then I'm not investing, it's just, I haven't seen the full confirmation. I like to always talk about, the example of St. Cristobal, which to me is such an important aspect. We don't find opportunities like a one-time free cash flow sale of an asset in a market where silver is trading at $50, $100 an ounce. You tend to find those when it's in the teens. And literally, if you look at the price of silver, it was a period in last, I think it was July of 2022, where the price of silver actually fell below 20 again. It went to 12 during the COVID crash, and then went above it, and then now it went again to 18. Do you know what people were telling me? It's going to go back to 12, Tavi. Don't you know about it? I didn't know that it wasn't going to go to 12, and neither of those guys knew about it. But one thing I knew is that the project I was looking at was trading at 1x free cash flow at the current silver prices. And given my macro views, if things double, triple, quadruple from here in silver prices, which I think is possible and probable, should I be buying this? And so that's the moment when you want to be buying distressed assets. And so I don't get too hung up on those things because I believe very strongly in my thesis. And I think ultimately comes back down. Now, I know I didn't answer your question because I don't know the timing either. And what I do know is that there has been a lot of buying from the gold front, mostly through central banks. How do we know that? Well, we looked at the GLD ETF. A lot of people have been covering that now. And we see that there's a divergence. That GLD ETF is not receiving funds as much as gold prices have been moving, but the design of that vehicle is supposed to rise as gold prices rise. Therefore, you're seeing a divergence. You look at the future positioning of gold, where speculators tend to speculate, and you're not seeing extreme levels there either. So speculators are not speculating as much as you would think. And then the third case is that central banks don't buy the miners, and therefore there's a lag between the two. So central banks are buying gold because they're in desperate need to improve the quality of their international reserves, and we're not seeing them accumulating the miners, and I don't blame them. That's not usually what they do. Now, when we think about that environment, ultimately it drives a speculation, because you start seeing gold prices rise. People start looking around, okay, if this is a real movement and those guys are really serious about accumulating gold, and by the way, if you want to know how serious they are, they used to own 70% of the balance sheets back in the 70s, and now they own less than 20%. That's how serious they are. And I think they're going to go back to those levels personally. So if we think about that as a trend, imagine if other general investors start considering, okay, well, if gold prices tend to rise, I should maybe look at silver. Maybe I should look at platinum. Maybe I should look at some of the miners. And at some point, that translates into growth of other assets too. So I think this divergence, despite the fact that the technicality of depending on each of the cycles, you tend to see different things in terms of leadership. I think ultimately the entire industry goes higher. And so obviously there would be opportunities depending on the risk, higher returns usually. And so obviously explorers carry most of the risk, but if you get into a secular market, you're probably going to have a secular market and with this very volatile and explosive for the explorers. Usually you see that with silver as well. Platinum tends to be that way too. And then you can dive in. Copper usually also goes along with gold. Zinc, believe it or not, which is crazy to think about it. Zinc is also usually aligned. And so you start looking at other metals, you'll be shocked despite the cyclicality and the nature of cyclicality of those assets, they're all kind of linked. If you are right about gold, you're probably going to be right about the others. And so that's why I focus so much on the big metal, because when that moves, and it has been moving, I think it's a matter of time for the other flows to kind of track those other leverage plays in gold prices.
Well, I definitely think that answers the question. I mean, you can never put a time frame. I was kind of teasing in that way, but I really appreciate you giving us this context, because that is giving a sense of urgency to some degree. Because people always wonder, when's it going to happen? When's this going to happen? And we can't tell the future, but we can see all these hints and these highlights, and we can see a lot of things developing. And when you have true value, people can just pick away at companies or themes they like with a long-term focus. One thing I want to tie in and see if you had a comment on, and then we'll wrap this up, is I watched a video with Frank Juster, and he's speaking about like the Canadian pension fund in regard specifically. And Canada being a natural resource country that people seem to forget, I think they'd mentioned that almost like less than 5% or 10% of any of the pension fund of Canada was invested in Canada, which I think is shocking to some degree, because granted, their job is to chase alpha as well, and they want to get the best returns. But at one breath, you'd think, wait a second, we are a resource-based country. They tend not to look at anything, but they also not look at any of the climate change solutions, which once again is mining by default. And you think, wait a second, shouldn't there be some sort of alignment between our government and our pension fund backing up the political ideology that's being pushed and pressed? And that alone message from the pension fund to say, yes, we're acknowledging this. We really want to stand behind this big push for climate change. What do you have any thoughts on that, or what's your kind of take?
I haven't looked into, in depth on this, but, my first thoughts that come to mind is were there this allocation outside of Canada by design, or did we see a major revaluation of the assets that they held out elsewhere, such as technology companies, I would suspect, that had performed so well that caused this allocation difference that we were seeing? And I think a lot of large pools of capital are kind of sitting in a portfolio like that, sitting in a portfolio that is, usually 60-40 portfolios. They have a very large percentage of equities. They're just conditioned on seeing technology lead the way. Technology always makes more money, supposedly, all sorts of things. And they're supposed to always see multiple expansion, and then how they hedge that is usually they buy a bunch of fixed income. Therefore, you tend to see instruments like TLT, the ETF of Treasuries, despite the fact that prices have been collapsing in treasuries. And when I say collapsing, the TLT ETF is down close to 50 or over 50% already from peak to trough. But if you look at the assets under management, it's actually still increasing. So people are still conditioned in, okay, I'm going to buy this because it's my hedge.
Yeah.
Now, what we forget is that hedges change and correlations change. And how do they change? It's all about, are you in a disinflationary and inflationary era? And there are more ways to kind of describe this, but I'm just trying to simplify. If you're in an inflationary era, it changes everything and it changes the whole environment. In fact, if you look at the 1970s, although the macro environment was very different, you can look at asset classes and industries, and you're going to find that gold actually performed better than most asset classes multiple times in the 1970s. Not talking about, from the beginning to the end. I'm referring to on an annual basis, gold actually performed very well multiple times. So it was the frequency that it really comes to mind. And if you look at the bottom performers, you're going to find technology companies actually. They're all at the very bottom there. And yes, commodities also did very well, and other hard assets did very well too. And again, it's nothing to do with the fact that we have a different macroeconomy today relative to back in the 70s, given the leverage and other things we have. The 40s was very similar in that sense too. So, I think we're kind of living in this environment where we've been conditioned for so long, these large institutions have been conditioned for so long to have a certain type of allocation, and it takes time for them to change that. They need to kind of, see the changes themselves, and some of them are facing that. And we're kind of living in an environment right now in where, I would say half of the market is already trading as if we were in an inflationary era. I'll give an example: gold rising with treasuries falling, gold rising with real rates going up. What? Yeah. I mean, how is this possible? Well, this is what happened in the 1970s. So there are some changes happening, and then you see rates going up, interest rates, treasuries, short-term, long-term, all of them are going up. And then you look at junk bond yields, and they're up too. They're up like about 8%. They're trading. So if you're a junk company, have a credit rating as a junk, you borrowing money at least at about 8%, 9%, but you used to borrow at 4%.
Yeah.
Okay. Well, why in the world the credit spread or the risk of default and the credit risk in general is so low today, given the fact interest rates are so high? Well, there's only one way to explain this, and I think, which is, are investors really thinking we're going to go back to a disinflationary environment where rates are going to go and collapse back to normal levels that we've seen in recently? Not normal, I shouldn't call it normal, because normal is what we're seeing now, but at least for the last 20, 30 years where interest rates are declining, is that kind of the environment that the market, that's sort of what's going on. So there's a separation of views in the markets right now, which is really interesting. And I think what's going to win is going to be that risk is too low. It's completely mispriced. Volatility is too low. Credit spreads are too suppressed. They're probably going to go higher. And then on the other side is the continuation of some of those trends like gold, commodities, natural resource companies, even the outperformance of emerging markets. All that is, I think, is real. I think that's a real trend. That's not just a momentum thing that happened in the last 2 to 3 years that we're likely to see a revert back to a normal trend. And I think that actually what we're seeing is a big shift of leadership in the markets, and it's being sort of obscured right now and difficult to understand because you're seeing technology still leading the way, mega caps is still leading the way, AI being so pronounced that is kind of hiding the big opportunity.
Well, Tavi, I really appreciate you taking the time here. Fascinating stuff. I always enjoy listening. Everyone, Crescat.net. There's a wealth of information on there as well. And you can see I've got all of Tavi's links too on LinkedIn, constantly posting things that are wonderful. A lot of this data as well. And I think that's what, you get lots of comments, lots of referrals because you're sharing this openly with people. And it's as much education that we're not getting from, say, a mainstream news, and not for any conspiratorial theory. They just deal with the bigger, huge market caps, and they don't want to necessarily lead the charge in a big thematic change. They'll talk about it when it's time, and they are. Like CNBC's talking about it, they're starting to talk about it. But if you want to get ahead of the curve and get some education, check out Crescat.net and definitely follow Tavi. Once again, thanks so much. It's great information, and we love talking to you.
Thank you very much, Andrew. Thanks for having me.